Thank you for joining me this morning or this evening, depending on where you are, for my presentation, Planning to Retire in Australia, Our Guide to Long-Term Departure Planning, Part 1. Next month will be Part 2, where we'll go through the phases of an expatriate move, and then looking also at how the type of advice changes over the course of that time. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists, a boutique wealth management firm headquartered in Minneapolis, Minnesota. However, I am located in Brisbane, Australia for almost the next year. So just to be sure, today's presentation does not constitute personal financial tax or investment advice. We have sourced everything here from reliable sources, including the IRS, the ATO, and our own resident PhD tax researcher, Dylan Golding, who's also on today's presentation. So in case you happen to miss any presentation or any other presentation that I reference here today, you can always find them uploaded to YouTube about a day later. We send a notice to all registrants. Of course, there's a difference between webinar registrants and attendees. If you can't make it to a particular event, then just look on the YouTube channel and you'll see it there. A little bit about me. My name, as you've gathered, Ashley Murphy. I'm a CFP, tri-citizen, born in the UK, raised in Australia, and have lived in the US for 16 years and shall be returning next year, as I mentioned. I worked in corporate finance initially, and I've got a story I'm going to share with you later in today's presentation about that. But really my destiny was to be a financial advisor. This is what I was born to do. I love it, and I love making a difference in people's lives, and money is the resource of the 21st century, and having the street smarts with money, it enhances what you're able to do with your lives, and enhances your possibilities, and opens up freedom and choices and possibilities, and I just love that. So I've been a regular conference speaker for XY Planning Network, Financial Planning Association, ANZ Bank, whole bunch of different organizations. I'm also the founder of the Global Financial Planning Institute, where I am the one that and my staff are the ones that train other financial advisors in what it takes to actually advise an international or cross-border client. Some of the things that we assist clients with here at Arete Wealth Strategists would be listed right here. You can see examples of business owners living in the US, or high net worth Aussie families also living in the US, or Australian executives permanently relocated to the US or moving back. Okay, so today's presentation was prompted by a prospective client who I spoke with a few weeks back, and I thought, this is such a great client. I'm looking forward to working with them. What are the thought processes that I have that go through my head, and what would I bring up as being relevant in an engagement with them? And this is why it turned into a two-part presentation, is because there's a lot to go through. So firstly, there's going to be an overview as to their goals and their situation. Then I'll talk about overall planning goals that one may have. It's broadly applicable. Talk about fundamental concepts to be aware of. Look at an asset transition plan for how they're getting ready to move their accounts and all their assets from the US to Australia. We'll look at a foreign exchange plan as well, a transition of accounts, and lastly, a transition of advisory team. If you have any questions, it would be great if you could hold those until the end, and I'm going to leave some time to address that. But I'd love to hear from you. If there's anything that's unclear, then take a note throughout and then just bring it up at the end, and we can cover off. So here's what I had noted down that this prospective client had mentioned. They said, we want to go through a departure planning process to make sure we don't leave any money on the table. We don't make any mistakes that would be costly to us. We want to make sure that our investment management situation is taken care of, that retirement planning is considered from both the US and the Australian side. And looking at their situation, they've lived in the US for the last 9 years, seeking to retire upon moving back to Australia, have investable assets of $2 to $5 million, and the wife and this client are Australians living in the US. Very good. Now, what I always like to emphasize when talking about international and cross-border financial planning is that this is a very specialized area that is an overlay to domestic planning. Any typical CFP, Certified Financial Planner, is trained inherently in domestic issues. So there are specific topics that come up from time to time to do perhaps with some complex estate planning strategy, or special needs planning is another example, where these are additional topics that would expand an engagement, whereas the international and cross-border advice, this is an overlay. And what I mean, why do I use this different language to say there's an additional topic versus an overlay? The point I'm trying to make is that when one is planning across borders, it affects everything. It affects your investment management, your retirement plans, your tax planning, your estate planning, everything is affected. So the recommendations that we're talking about here today are really over and above the traditional, do you have enough money to retire? Can we be done at age 55 or whatever the case is? And what's the best way to take Social Security, et cetera, do we have enough life insurance? Whatever the case may be, these recommendations, this presentation is looking at all the considerations we need to have over and above simply addressing those domestic issues. Okay, so what are some of the planning goals in looking at this prospective client situation, which I think is broadly applicable, and hence why we have the level of interest here in today's presentation. So first, I'd say, is obtaining a step up in basis on gain assets. We'll talk about that in a moment. Distributing retirement accounts tax efficiently. Now that's going to depend on your US legal status, and we'll get to that once we look at fundamental concepts. Minimizing foreign exchange fees, the cost of foreign exchange, minimizing foreign exchange risk, and that is the possibility of a negative exchange rate movement that may happen when you're transitioning countries, and avoiding exit taxes. Bad news there if you get hit with that, but there's, again, plenty that can be done to plan in advance. And that brings up something, a question that is raised quite frequently, and that is, folks they'll look at engaging with an advisor and they'll say, Ashley, give us your honest opinion. What's the best time to engage with someone like you? Because you're not working for love. This is not a nonprofit. You're charging a fee, and I want to know that I'm not engaging you too soon to start working. And my answer is, the effects of planning are compounding. So therefore, the earlier, the better. Now, you'd expect me to say that. I genuinely and sincerely believe it, however. And an example of that, the reason that came to mind, is I think about avoiding exit taxes. And the way that tax is determined is quite complex, first of all, but a lot can be done to mitigate that depending on your circumstances if you have years to plan in advance. And the reason I say years is because that is the tax accounting unit of measure. They don't deal in days and weeks and months and quarters. They deal in tax years. And there are limits on how much you can transfer, how much you can gift between spouses on an annual basis. So therefore, years is the relevant unit of measure here. So planning goal number one, obtaining a step up in basis on gain assets. So how does one actually go about doing that? Well, it boils down to your legal tax status. Sorry, your legal residency status. And what do I mean by that? What's legal residency? How are you in the US? Are you on a visa of some kind? Are you a permanent resident on a green card? Or are you a dual citizen? That's going to change things quite a bit. And here's how the step up in basis is made possible. Unfortunately, it doesn't work in reverse. The US has got a completely different set of rules if you're moving from Australia to the US. Maybe I should do a different presentation at some point on folks moving from Australia to retire in the US, but that's not today. So Australia sets the tax basis on foreign assets on the date you resume Australian residency. We should do a presentation on what that means, because residency is not always straightforward, and it's very complicated, in particular for dual citizens. But for pretty much anyone else, for green card holders or visa holders, it's really going to be very shortly after, if not immediately upon entering Australia. So the downside of this is that if you are a US person or have US sourced assets, and we'll define what that means, the term source there a little later, it won't be possible to get that step up. And that's because as a US legal resident, you are therefore a US tax resident, because the US has this rather unique citizenship-based taxation system. And as a result, you won't be eligible for that step up. But for Aussies that were in the US on a green card, or that were not long-term residents, meaning in fewer than 8 years, or were in the US on a visa, if they have gained assets, when they return to Australia, bang, they get a step up in basis, because Australia is going to say, we don't know what you bought it for. We're just going to tax it as of the day that you're deemed the basis to be the day that you move back to Australia, and the fair market value that existed at that time. So planning possibilities. Is it possible to gift or transfer assets to a non-US spouse prior to that move to maximize the step up? That is a fantastic possibility. This came up for us as recently as last week. We have a new client we onboarded, and they've come into some money, significant sum of money, and one of the spouses is a dual citizen. The other they met in the US, they moved back to Australia. They've received this payout in the US, and now that they're back in Australia, the question is, who should hold that money? And I did a two-part series on planning for mixed nationality spouses, which you can go back and look at. But in this case, it was deemed, given that we're holding these assets in the US, makes the most sense to simply hold it in the US spouse's name. So if they were to perhaps, if they were to want to change that, then they would be limited to $159,000 per year. That's the maximum amount that can be transferred or gifted to a non-citizen spouse. They can potentially move that over to the non-citizen spouse and enhance their either their exit tax or their estate tax possibility in the future by getting that out of the clutches of the US. However, pretty complicated stuff, and that's very, very client specific. Next, avoiding US source assets at departure, as these will not obtain a step up in basis. So as I mentioned, I'll be talking about source in just a moment. The point here, very simply, would be real estate, having US investment real estate, even if you're in the US on a visa, or you're not a long-term green card holder and you have US real estate, investment real estate, that's something that you would do well to consider not holding at the time of your departure, because it's not going to be eligible for that step up in basis. Of course, if it's cash flow positive and it's otherwise justifies itself some other how, then by all means, but that's going to be an example of where you're not able to take advantage of this tax move. Next, distribute retirement accounts efficiently. So for non-US persons, again, there's your visa holder and non-long-term US green card holder. There's great news. You're able to utilize the tax treaty, take the position that you have a foreign trust, and therefore the only tax owed on that account is going to be the growth. Thus, the employer and employee, i.e. your and your employer's contribution into that retirement account, is deemed the basis. And anything else on top of that is the taxable amount that would be taxed by the ATO back in Australia at your marginal rate. That's not great. People don't want to pay tax, but overall, it's a fantastic deal. And it's especially attractive considering you may be able to employ what I refer to as a super re-contribution strategy. Two things to be mindful of here, and I mentioned this in last month's presentation, which was a premium presentation. I should mention, we donated proceeds to an Afghani refugee cause, but that presentation went into detail about concessional and non-concessional contributions, and how for concessional, there is a retroactive rule where you can bring back up to 5 years of concessional contributions. So that's a fantastic strategy, meaning you could contribute that back into super and pay an effective rate of 15%, given that that's a super contribution tax, essentially. And for that amount that was not taxed or is not taxable in Australia, the employer and employee amount that forms the basis of that account, you could take advantage of the 3-year bring forward rule to make a non-concessional contribution. A lot of confusion exists about this. When I start talking about contribution strategies, then the people say, well, gosh, do I have to contribute this to a super account? Because a super account is a retirement account, as a 401k is. There's no obligation when you're moving from the US to Australia that you have to contribute it back into super. It's simply one of the more easier, readily available, and broadly applicable tax advantage strategies to take advantage of. But there's no obligation to do that. So step up in basis, I've not defined a step up in basis. So essentially, this is a tax principle where one's taxable basis is what you purchased an asset for, then you go and sell it, you owe tax on the gain. And so to have a step up in basis means your taxable basis gets stepped up. So you pay less tax on the total amount of that gain. Step up in basis is a great thing. It's going to save you lots in tax. So for a US person, the options are a little bit different, not as advantaged, unfortunately, but really it boils down to distribute the account immediately. Not great, or rarely does that make sense. Why? Because very often folks who are moving back to Australia are still in their income earning years. That means they're in a higher marginal tax bracket relative to what we might expect a few years from now when they're retired. And any of these contributions, because the retirement account is considered US source, they're going to be paying US taxes on that. So taking a lump sum is very often an inefficient way to do that. You could, if you're under the age of 59 and a half, you could distribute it over a minimum of 5 years and take what's called a 72T, substantially equal periodic payment distribution. If you wanted to get it out sooner and not pay penalty tax, remember the US will hit you with a 10% penalty tax if you distribute the account under age 59 and a half. So that's not good, or not as good either. The third option here is simply waiting till age 59 and a half, let it ride in the US, and then distribute that slowly, being mindful of your marginal tax bracket. You don't want to experience a spike from one year to the next where your marginal bracket pops up. Let me define this very briefly, if I may. I never leave home without this any longer. I have my key financial data sheet right here. So what I was referring to there, being mindful of your tax bracket being spiked. If you had $1 million, let's say, in your 401k, you moved to Australia and you wanted to distribute that, then here are the marginal rates. You can see here in these left columns. Married filing joint is what I'm looking at right now. Keeping your income below $81,000, your taxable income below $81,000 is going to keep you in a 12% federal tax bracket. That's wonderful. The rudest shock in the whole progressive tax scale, other than from 0 to 10, is the next step up, where you have to pay 10% more for every dollar of taxable income above that $81,000. So my point is, be mindful in how you're distributing that retirement account so that you're not paying extra tax. Excuse me, let's get back to that slide. This is where we were. Okay. Okay, so don't bump up into the next tax bracket. I did see a comment there. I'll just take a moment to read that. But if we put larger amounts into super, particularly using the favor rule, want the US deem your super account to be a foreign guarantor trust. Depends on your, thank you, Jim, depends on your US legal status. So if you are a US person, that's absolutely a concern. and I'm not recommending that you do that. That would be applicable for the non-US person, which is why it was something brought up under the guise of the non-US person. So again, be sure to seek personal advice. This is not, do not take advice based here. If you've got questions or are unsure about what's being said here, this was under the heading of a non-US person. For the US person, we're not, it says right here, you would not be able to employ the aforementioned superannuation recontribution strategy for that reason and others. Okay, so next, minimizing foreign exchange fees. Foreign exchange has got to be the most boring topic. I ran a webinar on this about 2 years ago, and then I had very few people register and even fewer people attend. Foreign exchange puts people to sleep because most people, and I'm pounding on the desk, most people think there's nothing to it. They think, I'm with OFX, I'm getting the best deal out there, and there's nothing more to be done or said about it. Wrong, wrong, wrong. Let's look at an example here. Let's say you had $1 million US dollars and you were wanting to convert that back to Australian dollars. So here we have highlighted in yellow, $1 million US dollars. If you happen to be a bank, which of course none of us are, they get the interbank exchange rate. So at the prevailing rate an hour ago, when I put this slide together, we were looking at 72.3 approximately US cents to one Australian dollar, which would have yielded you 1 million to be equal to that. Okay, unfortunately, none of us are banks, so the next best thing we could do is have an account with Interactive Brokers, and they're going to take a spread equal to $27.67. Next best is the rate that we've negotiated for our clients and Dean Collins with AFEX, which is a 10 basis point spread, which would mean it would cost you $13.84 over the interbank rate. Next best is Wise, formerly TransferWise, and OFX. Their spread is 60 basis points. So that's going to cost you $8,300 in foreign exchange fees. Or worse, much worse would be you could use your bank, private banks, and clients of private banks will get slightly better rates, but they're still not that good. You're on $1 million, you're paying $27,000 to simply convert your funds. And then worst of all would be the airport conversion rate, which can be as bad as 5 or even 10%. And no one, of course, is doing that in reality, but you can see this is real dollars that are on the table here. Next, foreign exchange risk. Now, you might think I've lost track of things. Didn't I just talk about foreign exchange? This is a different topic altogether. What is the risk I'm referring to? The risk here is having an asset denominated in one currency set aside to fund a goal that is in a different currency. And I've got a great story to share with you from more than a dozen years ago. Back in the day, I was working at Visa. I was in their marketing department, and it was a very interesting job there, looking at all the different things that Visa spends their money on for marketing. But I digress. There was an executive there who had just moved from London, and she sold her home for about £1 million. Let's step into an example just for 1 second here. So she sold her home in London for £1 million, which was wonderful because at that time, the exchange rate was about 2. So her million became 2 million. We can see that over here. I like to use daily FX's foreign exchange rate. So back in early 2008, she sold for £1 million. And as I mentioned, it was worth about $2 to the pound at that point in time. So she moved, she got settled, she discovered Northern California and what the good neighborhoods were and where she wanted to move. But unfortunately for her, without having employed a foreign exchange strategy, in that same year that she made that move and was getting closer to actually buying the house, that was coincidentally about $2 million, the exchange rate crashed, as you see right here. And that was the global financial crisis commencing in about July, which was really before the major drama that occurred in September with Lehman Brothers. But occurring in July, this crash took place. And so all of a sudden, she had thought she could buy her lovely home in Foster City or Burlingame for cash, but that was not going to be the case. Instead, she was going to come up about $500,000 short. So that is exactly the risk that I'm talking about, foreign exchange risk. How do we manage that? I'll get to that in a moment. Next goal is avoiding the exit tax. Now, who gets hit with this? Really, two folks do, and that would be US citizens looking to relinquish their citizenship, or individuals holding a green card for 8 or more of the past 15 years. There are then 3 tests that are applied. Are you current with your taxes, state, city, state, and federal for the last 5 years? Number 1. 2, do you have an average federal tax liability? Notice what those particular words: federal tax liability. That does not mean total income. It's federal tax liability of, I believe it's about $171,000 in 2021. That's of the last 5 years. So you're going to be making pretty good money. We're talking $800,000, $900,000 to have a federal tax bill of $171,000 over the past 5 years. Not too many people get hit by that. The third one that catches a lot of folks out is, do you have a global net worth of more than $2 million US? If you do, and it's not inflation indexed, which is awful, then you will be deemed a covered expatriate, and there may be an exit tax to pay. How's that exit tax calculated? Well, that's a whole nother presentation for another time. But thankfully, there is an exemption. There's a 700 and something, I think it's $750,000 this year, capital gains exemption that is applied. But mostly the way that exit tax works is, if I was to simplify it, I would say the tax is very similar to filing what's called a 1041 tax return. That's the one that it comes one after a 1040, and it's for when you pass away. So an estate tax return. So it's essentially saying, as if you died, we're just going to tax you on all of your different kinds of accounts and give a capital gain exemption. And there's a few other things that are a little bit different, like 401k accounts, where they can't tax them presently because they're not accessible. They'll hit you with a 30% withholding tax, and you forfeit your treaty benefits as well. So the exit tax is certainly bad news. So those are our planning goals. Just going back and reviewing those quickly. Those were, not the outline, they were obtaining a step up in basis on gain assets, distributing the retirement accounts tax efficiently, minimizing foreign exchange fees and risk, and avoiding the exit tax. Now we move on to talk about fundamental concepts. So fundamental concept here would be legal residency. Legal residency, current legal residency, and any changes planned. In my initial fact finding, I always ask about this. I say, so how are you in the US? Are you here on a visa or green card, or are you a dual citizen? Now, the financial planning implications often run counter to simple peace of mind, not having to file for an extension of a visa every couple of years and go through that uncertainty and heartache and expense. A lot of folks choose to become green card holders or get on the citizenship track for that purpose, because it's going to make their life a little bit easier from an administrative point of view and an immigration point of view. The thing is, it can really come up as a problem with regards to financial planning, especially if you see yourself moving back to Australia permanently. You've now, as I heard just yesterday, I was speaking with a young lady who had just done that, given that her children were dual citizens. She wanted to have the same status as the kids, but had not heard of this before, and didn't realize all of the complications that this is going to bring about. So permanent residency, dual citizenship will fundamentally change the track of advice. So if someone, if they said the fact pattern is going to be one of 3 things, we're either going to have a single client or a couple, neither of whom are US persons. We're either going to have mixed nationality couple, or we're going to have dual citizen, or doesn't matter, but someone's still a US, both are still US citizens in one way or another. Those are the 3 permutations. So with US persons, you're going to have ongoing tax filings, and you're going to have complications with your Australian investments. because now you have to worry about them being deemed PFICs, passive foreign investment corporations. Again, I've done a webinar on what that is. It's fairly complicated, but you don't want it, is the long and short of that. It's going to result in not only higher taxes, significantly higher taxes, but oftentimes, and I mean in the majority of cases, the worst symptom is actually the tax filing for the PFICs in the first place, given the time and the expense that you're going to incur complying with those rules. If a couple does have a mixed nationality status, then we can locate foreign assets with one spouse and keep the US assets with the US person. As I was talking about before with that new client that we took on, that would be a way of not encumbering the non-US person with having to file US taxes. Fundamental concept number 2, source of income. This shouldn't be that alien, this concept, for anyone that's lived in the US who perhaps has had investment property in the US, because you deal with it on a state basis. If you own an investment property in one state, live in another, then you'll know that you have to file taxes in that other state, because that investment property is deemed to be sourced from the state where the property is located. So really the concept of source of income is, where does that income come from? So real estate is going to be based on the location of that property. In our presentation, obviously, we're less concerned with individual US states. We're more concerned about countries. Where is that? Where do you hold real estate that's producing income? If you're a non-US person who's moving back to Australia, permanently planning to move back, and you hold US investment real estate, well, you just bought yourself the privilege of having to file US taxes as a result of that. Trust, it's going to be based on where the trust income is earned. Businesses, more complicated. Personal services and inventory businesses will differ, but essentially personal services, it's based on where the services are performed. That gets even more complicated if you are a dual citizen, given that the tiebreaker provision in the treaty comes into it at that point. And third is location of assets. When I was putting these slides together, I thought to myself, source of income and location of assets, are they really the same thing? And the answer is no, they're not the same thing, because the planning concept here is, where are those assets located? If they're still in the US, you're planning on moving to Australia, we've got to come up with a plan to get it from one country to another, and one currency to another as well. So where are they located? Not only does it have an effect on source, but there may be issues to do with keeping the accounts open upon departure, thanks to FATCA. FATCA, which came into effect in 2010, Foreign Account Transaction and Compliance Act. It itself was a result of the fraud that was taking place with Swiss bank accounts. And so the IRS and the Treasury Department got really serious about cracking down on undeclared foreign bank accounts. And so they came up with FATCA and began to also enforce FBAR's foreign bank account reporting as well. The problem for you, for retail clients, is the penalties. Not only do they fall on you, but for practical purposes, the problem is the institutions are also fined as well. So all of a sudden, the institutions got really serious with enforcing and finding out who are the US persons on their books. And oftentimes they would close or restrict or create problems for US persons who held foreign bank accounts abroad, or alternatively, who moved abroad and had US-based accounts. I've come across this a lot lately with clients who were with Raymond James. Raymond James in the US decided, we don't like Australia anymore. We're not going to have clients open or trade. So they've restricted those accounts. And that sort of thing happens all the time. That was just in December of last year. Avoiding a liability mismatch. I'll talk about this in a little bit more detail, and I already have actually, to do with having a goal in one currency with an account that's in a different currency, and the risk that that potentially introduces with how things change. So I mentioned that a moment ago, FATCA and AFSL issues. AFSL, Australian Financial Services License issues. It happened just last year. It was March of last year. Interactive Brokers the venerable US-based financial institution was previously available to clients in Australia who moved. They opened their accounts in the US, they moved to Australia, they could update their address, and they were fine. Suddenly, due to changes in the compliance regulations for AFSL holders, as of March of last year, they changed their minds and they said, we're not happy with anyone in Australia, we're going to restrict your account too. So there's a whole set of problems that came up for those particular individuals in having to then find a custodian that was happy to have an Australian address on file and keep their US assets as they were. And then all the same tax filings that I spoke about before, informational filings on what your bank accounts are over $10,000 for FBAR, over 50, it varies depending on your tax filing status and where you're located, but FATCA filings as well. So there's all of that. And then creating a transition plan. How do you actually move your assets from one country to another, over what time period, and how do you mitigate that foreign exchange risk? So source of income, once you move back to Australia, will there still be foreign sourced income? That could come from, depending on how you choose to distribute your retirement accounts, could be retirement accounts, could be investment real estate, businesses, trusts, as we have looked at already. And then interest, although interest has really become a negligible concern in today's interest rate environment, where it is very hard to get much at all. Okay, so creating an asset transition plan. What I'm showing you here is a demo of what we put together called a client investment plan. And essentially, this is an investable asset balance sheet, not a total household balance sheet, including businesses and real estate, just investable assets. So what we're looking at here is a little complicated. Let me break it down. So moving down the columns, we've got cash assets, after tax, investable accounts, and then retirement assets. Okay, then we have it broken down by client one, client two, what's held jointly, and then the totals of both, represented in red in US dollars and in blue in Australian dollars. So this was the demo client account beforehand. And then once we put together a transition plan, we say, this is how we would suggest you break it down. And these vary over time, by the way. So this is a static look at a particular point in time. And what we're saying is we need to move to the recommended US bank and brokerage institutions, have some money in your financial independence plan in the US. Also in Australia, we're splitting it, as you can see here. In this particular case, the client still had some money in 529 accounts. That's going to lose a lot of its appeal once you move overseas, considering that Australia never had the manners or the mind to consider what the implications were. Excuse me, I should say the US never had the manners or the mind to think about what the ATO might think of this thing called a 529 account. And so when Australia looks at that, they say, we don't know what this thing is, and we don't treat it the same way that you would back in the US. So that still exists. We're not adding or contributing that anymore. And then recommending specific rollovers that don't cause a tax realization event. In the case of super, we can't do that necessarily without causing a tax realization event for US persons. So that is something to be mindful of. The broader point of this slide here is coming up with a plan for how you're transitioning your assets over time from one country to another. Next, coming up with a foreign exchange plan. What are we looking at here? We love spreadsheets. I used to say that I Excel all day long. And so a lot of this work is pretty heavy in Excel and spreadsheets. So what do we have here? We have a foreign exchange plan. And what we do, which is fairly complicated, is we've done a study going back about 10 years, looking at the exchange rate at various points in time. This is the New Zealand to US dollar, by the way, for a very particular client of ours. And what we've done is we've said, what was the quarter beginning exchange rate? What was the average for the quarter, the high, the low, and the standard deviation for that quarter? The thing with foreign exchange is it's quite different. Let's look at the Australian dollar here. I just went back, and now I'm going to maximize this so that we can see it a little bit better. The thing with stock markets, let's go here, indicators, Yahoo, just very quickly. I want to bring up the, okay, market's closed right now, so it's just showing us S&P futures. But if we look at the stock market over long periods of time, look at this. So we're looking at 15 years. The general trajectory is up. If you were to draw a trend line, you would say, yep, it goes up. It doesn't go up every single day, every single week, month, quarter. No, but the general trend line is up. With foreign exchange, it is not that way at all. Let's come here. I'll maximize that. Sorry, just bouncing around. With foreign exchange, look at that. The trend line, which is only going back to, well, sorry, not only, it's going back to 2004. So that's a fairly good period of time, but we see extended periods of time with a move up, and then another couple of years with a, or we should say month or two of it crashing, and then another couple of years of it strengthening, and then a decade of it declining, and then another 18 months of it strengthening, and then suddenly we've been in for another last few months of it weakening yet again. My point is, foreign exchange does not, it doesn't have this gradual increase that we can look at. And so as a result of that, we need to put together some sort of systematic plan to take advantage of exchange rates, because no one knows what the future holds, and anyone that's trying to tell you that they do, you should run the other direction from. So we're really trying to focus on what we can control and not what we can't here. So the idea that we're doing is setting a number of standard deviations worse than the prior quarter average, and then being very conservative about better than, and then setting up these limit orders to trade automatically depending on the variance over that quarter of time, over that particular quarter. And what we found at the strategy is most of the time, 62% of the time, it ends up trading at a better exchange rate. So we like that. And then here's a log that we see of a particular demo client. And this is what we're doing, is we're converting, as I mentioned before, it's a New Zealand, an Aussie who lived in the US going to New Zealand, converting into New Zealand dollars in specific amounts where we're being opportunistic when we see the exchange rate being low. Of course, it was better back then. We didn't know it. We saw the trend moving, then we converted a bit more, and then moved into quarterly tranches over that period of time. But you can see in this particular case, we're using a 4-year conversion window to get about $11 million US over and converted into New Zealand dollars. So the point is, we're using a long period of time and an intelligent strategy, well thought out strategy to do that. Lastly, here is a transition of an advisory team. It's worth noting, very few firms with there exist very few firms indeed with specific cross-border Australia-US knowledge in our domain. There are compliance issues for why that it's not feasible necessarily for a firm to be registered in both countries. In my case, in Arete or Strategists' case, we're registered in the US. We can work with exempt clients, wholesale clients are their name, with more than $500,000 of investable assets in Australia. But as fiduciaries, there's a certain level of complexity that may arise in someone who's since moved back to Australia, where we would want to recommend that they work with a local advisor who's dealing in the local environment every single day and has that familiarity. I am first and foremostly a US advisor. I do have knowledge of the Australian system, but I just as a physician who's a neurologist, maybe they understand general medicine, but someone presented with another symptom, then the right thing to do is to make a referral to that specialist, and that's the same that I'm talking about here. So I'd recommend someone talk to a domestic planner who understands the complexities that the US presents given that situation. And I happen to be partnering with a firm, a fairly large firm in Australia, so we're able to provide that kind of bookended solution. At this time, I would like to open up the floor to any questions that you may have. And this could be a great opportunity to have a drink of water and just let people write in some things. For chat, anyone wants to say hello, or maybe people's heads are spinning. Ron Larson writes, you were going to talk about 401k distributions. And indeed I did. Roth distributions. I guess there's a question being followed by that. I was going to talk about 401k distributions, and I did. That was addressed earlier. And so the point there is to do with, if you're a US person, you're really in no different a situation. And in fact, it's more complicated because now you need to worry about how Australia treats your foreign retirement account, and there could be supplemental tax to be paid, highly dependent on individual circumstances. But I did address that earlier on 401k. Social Security payments, I would suggest you check out my webinar. I did a 2-part webinar on Social Security, claiming that from Australia. Good news is it has nothing to do with your legal residency status. So if you were in the US as a temporary resident on a visa, then if you vested over your 40 quarters of work in the US, then you may be eligible for that. And your spouse, they may receive a spousal amount also. And Roth distributions, you know, the thing with Roth is, again, going back to my point about the compounding benefits of planning, Roths don't really make a whole lot of sense, I would say, if you're planning on moving back to Australia, because the same principle applies to Roths as applies to, tax deferred defined contribution retirement accounts. And that is, the ATO looks at a Roth and says, we don't know what this is. We think it's a foreign trust. We're going to tax you on all of the growth of the account. Well, isn't that defeating the entire purpose of having the Roth in the first place, because you funded it with after-tax dollars so that you didn't have to pay tax again? So I'm not crazy about Roths for folks moving abroad. In the US, on the other hand, if you're moving into or staying in the US, then I think Roths make a whole lot of sense. Daryl, so AFEX, do I have a contact? Absolutely, I do, for clients. That's who we assist there with that particular, the 10 basis point rate that I mentioned. Laura, hi Laura. As an Aussie on an E3, if you begin moving cash over gradually, are there any tax implications in Australia once it has moved there? Generally no, but that's why professionals exist in this space, because at a certain limit, maybe someone could chime in. There is a very obscure ruling in Australia to do with growth on foreign exchange and how that can catch you out. But that's really only going to be for high net worth folks. So it's not a concern for mass affluent individuals. I'm going to swap back over to the chat. Just here, Gerald writes, what about assets held in a family trust in the US? One spouse is a US citizen for long-term green card holder over 20 years. What is the process required to escape the IRS? There isn't, unfortunately, in that case. There isn't. So they're long-term. That means they're going to be assessed as possibly being covered expatriates. And the citizen, by virtue of relinquishing, if they were to do that relinquishing citizenship, that's a can of worms, and that's going to be bad news. For non-US personal retirement account, is there a difference in treatment of Roth 401k versus 401k? Yeah, there is. It's worse. It's the same point that I was making a minute ago with Ron's question, and that is, you paid into that with after-tax dollars. You were hoping to get that money out tax-free in the US, but if you move to Australia, the ATO looks at that and says, well, hold on a minute. This is a foreign trust. Corpus basis, taxable basis, equals employee contribution plus employer contribution, taxing you on any growth on that. Well, it didn't work out as you were hoping, unfortunately. So thank you, Gerald. Next, going to move over to Andrew. Are there opportunities to transfer assets to children to minimize tax utilizing trusts? Yes. But if the kids are dual citizens, does that maybe mitigate or eliminate, would be a more accurate way of answering that. It might. It depends on your net worth, Andrew. So if the most recent proposal from the Biden administration looks to be decreasing the estate tax limit down from the current 11.7 million per individual with estate tax portability between spouses down back to 5.5 million. So depending on your net worth, that could be a strategy. Also, there are a number of other exotic estate planning strategies that are likely to disappear after 2021. So time to get on that. If your kids are dual citizens, though, and that's not your situation, where you're not concerned about estate taxes and that's not the motivator for this, then not really, no, because they're simply going to be facing the same complexity that you would as well. I wish I would have known about the tax benefits about staying just an Aussie citizen. I'm a dual citizen, but my wife isn't. Sorry to hear about that, Daryl. However, the good news is that there may be strategies of, while reduced and fewer in number, there may be some possibilities to locate certain assets in her name and things in your name to get you some benefits there. Moving back over to my chat window, Ronga writes, does a US citizen pay an exit tax only if they renounce US citizenship? They don't necessarily pay that tax at all. It's more, the first step would be, are you deemed a covered expat? And then do you fail one of those tests? And then if you do fail a test, then they'll assess you. But does the composition of your whole financial life necessarily mean that that exit tax would apply? Maybe, probably a little bit if you've got super accounts and 401ks, but it might not be that bad. And we get deep into that with clients where we've developed our own model for that exit tax. And I'm thinking back to a client I met with 2 weeks ago. He and his spouse got a green card. It's about 2 years ago, making pretty good money in California at a tech company. And what we could see was that by 2025, they would become long-term residents and an exit tax would apply. And I think the initial year in which the exit tax applied was about $100,000 with the way that the formula calculated given their financial composition. The thing is that their net worth was increasing, if I remember correctly, every year thereafter by about $300,000, and the exit tax was increasing by $30,000. So 10%, you could think of it almost as a 10% wealth tax, but only on the incremental gain. And if one were to rephrase that question and say, every additional year that you stay in the US, you're making $270,000 more, yes, there's an exit tax, but compare your earnings to what you'd make back in Australia. And it just so happens the tech sector, it's pretty well known, just doesn't pay quite as lucratively for those mid to senior level positions back in Australia. So the choice they had to make was stay in the US, pay an exit tax, but make a lot more money, or move back to Australia and not pay an exit tax. And I think the point is you really have to look at it on an individual basis. Kes, hi Kes, I hope you're well. What about rolling up your US retirement accounts within 6 months of Australian arrival? Otherwise, you get to pay the whole freight of embedded gain and income when you make distributions at retirement. That would depend on your US status. So rolling up your US retirement accounts within 6 months of arrival, you could do that, but if you were a US person, I can't see it would provide any benefit, especially if you're under age 59 and a half, you'd get hit with a 10% penalty tax. I don't see it providing a whole lot of benefit. The other thing is the advantageous point, yet another advantageous point that the ATO has over the IRS is that the ATO will only tax you on those accounts at distribution. So you're right, your taxable basis, or I should say, excuse me, not your taxable basis, the taxable amount of the account in Australia is increasing over that point in time as the account gains. But on the other hand, it's going to be, you're going to have to pay that ordinary income tax in the US. Maybe there'll be a supplemental tax payable in Australia. is it worth accelerating or slowing that down? It's going to depend on your marginal rate and your particular circumstances. Where are we at for time? Got another 3 minutes here. I'm going to keep cranking. It's funny how when I give it a moment for questions to be asked, folks typically take a minute and they say, oh gosh, do I have a question? Then they keep flooding in. Marie, I don't have a spouse. Can I transfer to my sons to limit taxes? I am a dual citizen. Possibly, but that brings up some issues there. So I'm going to have to assume your kids also aren't US or dual citizens, because then there'd be no point. It would simply be creating a different problem for them. And then also, when you give something out of your name, it's not in your name. And so it introduces all sorts of uncertainty as to whether that may come back to you or not. I'll take one more question over here from the chat. I work for an American company from Christina. Hi, Christine. I work for an American company with stocks vesting. Okay, I'll be transferring to the Australian office. What happens with my stocks that will vest every quarter? Are they considered US based? I'm pretty sure they are. That's as simple a question as that is written within 3 sentences. That is often the sort of thing that ends up on the desk of a tax attorney. Where I've seen that in the past, that's considered the options or RSUs or whatever it is that you've got there. They typically vest in the country where you were working at the time. So your US vested positions, you've just said stocks, I don't know whether they're RSUs or options or whatever, that's going to be deemed US sourced. And then what you vest in Australia is now going to then become Australian sourced. So it becomes pretty complicated from a tax perspective, especially if you were a temporary resident in the US. You've now got to worry about filing US returns for as long as you have option activity in different tax years. So Chris, hi Chris, US citizen immigrates to Australia after retirement age. How is their 401k taxed in Australia? Easy. I mentioned that earlier. So it's deemed US sourced. That's first going to be taxed for the US. Then, depending on how that whatever foreign tax credit you can obtain from Australia, if there's a difference there, which there probably is, on what's owing in Australia, then you would owe that difference. You owe the higher of the two, but not double necessarily, merely the higher of the two. We go back to the Q&A panel. If you have time before your exit to do a Roth backdoor process, does that change your position of Roths? Absolutely not. That would be the worst thing to do. That would be magnifying the Roth problem. It wouldn't provide any benefit at all. Brett Villigran, and what's a Roth backdoor? That's essentially for those that make too much money to contribute directly to a Roth. What you do is you make a non-deductible contribution to a traditional IRA, then roll it to a Roth. And then you've contributed to a Roth, but then unless you were doing it for flexibility's point of view, if you didn't know if you're coming or going, then it's not going to provide you any benefit to do that. Brett, as a US resident, what are the implications if I get inheritance from Australia? The US loves to get money from overseas, and so they're generally not going to tax you on that. Anonymous attendee below Laura's comment there writes, is Oz in Australia, is the US Embassy Sydney opening up to cross Queensland state for renouncing? I have no way of answering that. Russell Barnett, if planning to move back to Australia in 5 to 6 years, would you generally advise building an asset portfolio in Australia ASAP or continuing to build in the US until closer to our leave date? You know what? That's exactly what I'm addressing in the second part of this presentation next month. So I hope you can join me for that. How are we doing on time? 2 minutes over. I'll just take a look very quickly. Thank you, Laura. Hey, Bryce, good to see you. Thank you for the comments. Thanks, Ashley. Just seeing, oh, John Barrow. Are you sitting at a piano as we keep hearing notes each time you bang down? But it does in some... I'm not, no, I'm not. But I do pound the table every now and again to make a point. Daryl, so it's my understanding that retirement in Australia is an asset test and that, and in the US, it isn't in a magic formula. The years and money invested in Social Security, the US is not an asset test. I'm not with you on that one. Thank you, John. Good to see you again. It's been a long time since I saw you in person in Minneapolis. Brett, again, as a US resident, what are the implications of inheritance? Oh, we already addressed that one. I think we've moved on to the, oh, Ron, last of all. We plan to keep our California house. We plan to spend 6 months in the US, 6 months Australia. Perhaps we can avoid the ATO and just use IRS rules. Indeed. However, Ron, with what I could infer from your prior question, I'm assuming yours is a fairly complicated situation. You would do well to seek personal advice. You would expect me to say that, but in this case, yours is one where there's so many moving parts in that assumption. If you plan to spend 6 months here and there, there's residency test, there's tiebreaker test that depends on your legal residency status. It's actually quite complicated. Yes, unfortunately. Thank you so much, everyone, and I hope you have a wonderful rest of your day. This will be up again on YouTube shortly, so thank you very much.